What's happening, everyone, and welcome back to the channel. This week has been absolutely wild in the economic landscape. We've seen some major developments that I want to break down for you today. Over the past several months, we've been tracking three major economic indicators that affect everyday Americans: border policy changes, price stability, and lending costs. We've seen significant shifts in all three areas, and today we're going to dig into what this really means for the average household. But here's what I want to focus on today: the disconnect between what officials are saying about American manufacturing and what the actual data is showing us. We're going to walk through the numbers, look at what's really happening on the ground, and separate fact from fiction. Before we dive in, let me just say, this past week saw some of the most dramatic market movements I've tracked in months. Stocks, commodities, currencies, energy markets, everything was moving, and there's a reason for that, which we'll get into. So, let's break it all down. The biggest headline closing out the week was the announcement of a new Federal Reserve Chair nominee. This is significant for several reasons, and I want to walk you through what this could mean. First, some background. The nominee has previous experience in monetary policy and comes from a traditional conservative economic background. The markets initially reacted with some volatility. We saw the dollar find some stability, while precious metals took a hit. Silver dropped dramatically in a single session. But market reactions in the immediate aftermath of these announcements are often more about sentiment than substance. The real question is, what does this person's economic philosophy tell us about future policy direction? From what we know, the nominee favors reducing the Fed's balance sheet and hasn't always aligned with the current administration's preference for lower borrowing costs. However, there are personal connections that suggest he'll ultimately support the administration's agenda. The interesting dynamic here is this: his stated beliefs emphasize that controlling inflation should be the Fed's primary concern. The traditional thinking is that if you keep inflation low, employment naturally follows. But here's the tension: if he pushes for rate cuts while simultaneously shrinking the Fed's balance sheet, that sends mixed signals to the market. Lower rates typically stimulate borrowing and spending, which can heat up the economy and potentially drive inflation higher. But reducing the balance sheet has the opposite effect. It tightens monetary conditions. These competing forces could create confusion for markets and might not deliver the economic boost policymakers are hoping for. We'll be watching this closely and providing updates as the confirmation process moves forward. Now, something happened last Friday that caught a lot of market participants off guard. The Bank of Japan conducted what's called a rate check. For those unfamiliar, this is when a central bank surveys currency traders about current exchange rates. It's a signal they might intervene in currency markets. Why does this matter to us? Japan has been dealing with decades of economic stagnation, and now they have leadership pushing for growth and stimulus. This is causing inflation to rise in Japan, which means their central bank is getting more aggressive with interest rates. Here's where it gets important for American investors and savers. Japan is one of the largest holders of U.S. Treasury bonds. If they start pulling money back to invest in their own bond market because yields are getting more attractive there, that's less demand for U.S. debt. And right now, with growing deficits, the U.S. relies heavily on strong demand for its bonds. This was the backdrop heading into a week that delivered some challenging economic data. Something notable also happened on the international stage. Two of America's closest traditional allies, the UK and Canada, have made moves to strengthen their economic ties with China. The UK Prime Minister met with China leadership, and Canada announced plans to deepen trade relationships with China. This represents a shift in the global economic landscape. When close economic partners pursue stronger ties with a strategic competitor, it suggests they're diversifying relationships amid uncertainty about the global outlook. That's a development worth watching. Let's talk about the job market. Some analysts pointed to the latest jobless claims numbers as positive news, but context matters. Yes, the most recent week showed fewer new unemployment claims compared to the previous week, but the prior week's numbers were revised upward. So we're not necessarily improving, we're just not deteriorating as quickly. This matters because the most recent jobs report showed very modest hiring. Slower workforce growth makes sustained economic expansion more difficult. We've also seen a wave of major layoff announcements. Large corporations across multiple sectors have announced significant workforce reductions in technology, logistics, telecommunications, food production, and manufacturing. These decisions are often planned months in advance based on outlooks for demand, order books, and cash flow expectations. Companies are signaling caution about the quarters ahead. There's another indicator that gives insight into where things might be headed: consumer confidence. The latest survey results showed declines in both how people feel about current conditions and their expectations for the future. In a consumption-driven economy, when people feel uncertain about job security and income prospects, they often reduce spending. That shift in behavior can ripple through the broader economy. Now we get to one of the most significant data releases of the week, the Producer Price Index, which measures prices that manufacturers and wholesalers pay, showed a notable increase. This matters because it's often a leading indicator. Changes in producer costs can eventually filter through to consumer prices. This index measures costs after raw materials have been processed, before goods reach consumers. Earlier in the year, retail price impacts from trade measures appeared limited, but this data suggests costs may have been absorbed earlier in the supply chain. If producers begin passing more of those costs along, consumer inflation pressures could increase depending on broader economic conditions. We also saw updated trade balance numbers. Imports climbed while exports declined on a relative basis. 1 month of data doesn't tell the whole story, but this was a reversal from the prior trend. Inventory cycles and earlier front-loading of imports may be influencing the shift. This dynamic can affect GDP calculations and raises questions about how trade policies are influencing domestic production and export competitiveness. Which brings us to the main topic: what's actually happening with American manufacturing? Recent commentary has highlighted construction activity related to factory building as evidence of a manufacturing boom. So, let's look at the data. Overall construction spending, combining residential and commercial, is down year over year. Some specific categories have shown growth, including infrastructure-related areas like transportation, power systems, water, and waste management. Manufacturing construction spending, however, has declined compared to last year. That's important because trade and industrial policies are often aimed at expanding domestic manufacturing capacity. Much of the growth in infrastructure-related construction traces back to earlier legislation that emphasized long-term public investment. Some current factory construction is concentrated in semiconductor manufacturing, which also benefited from targeted subsidies. Private construction outside those areas has shown signs of slowing, potentially due to interest rate levels and policy uncertainty. This highlights the complexity of industrial policy. Large-scale programs often take years to show results, and multiple policy eras can overlap in their economic impact. Many of the construction gains are in public works and municipal projects rather than broad-based private manufacturing expansion. There's also heavy investment flowing into data centers. Some analysts argue this has been a significant contributor to recent GDP growth. However, rapid expansion in energy-intensive infrastructure raises questions about grid capacity, long-term energy costs, and the need for complementary investment in generation and transmission. Construction and technical labor availability, trade measures on key materials, and financing conditions all factor into how sustainable this pace of investment will be. Major technology firms have signaled continued AI-related infrastructure investment, with significant funding coming through debt markets. These are large capital commitments, and investors are watching closely to see how returns develop over time. Geopolitical uncertainty adds another layer. Heightened tensions in various regions can influence energy markets, and energy prices feed directly into inflation dynamics. Input costs remain elevated relative to historical norms, and inflation is still above central bank targets. Producer price data suggests cost pressures are still moving through parts of the economy. Trade policy has had complex effects. Slower global growth can weigh on energy demand, while geopolitical developments can push prices in the opposite direction. All of this creates a challenging environment where policy, markets, and global events are tightly interconnected. That's what I've got for you today. Thanks for watching. If you found this helpful, consider liking the video and subscribing for more economic analysis. Drop your thoughts in the comments. I read as many as I can. Stay informed, stay critical, and I'll